I think we need to be careful when it comes to the Fed's reaction function. The fact is that they have done already a lot in terms of monetary policy. We expect plus 75 basis points in the next FOMC. That being said, what they would like to indicate looking ahead is that they will diminish the pace at which they hike rates. And I think if you call that a pivot is likely, I would say, by the end of the year or early next year. But this is not a game changer, I would say. We are getting closer to the terminal rate that will not be reached before the first quarter of next year. So let's be cautious when it comes to the Fed's reaction function. Core inflation is quite elevated in the United States. Real interest rates, the real Fed funds rate, when you deflate, for instance, the Fed funds rate by core inflation is still in negative territory, and the Fed wants to bring back real interest rates in positive territory. That being said, in the first quarter of 2023, the Fed will want to wait and see, to watch and see, because monetary policy impacts economic activity and inflation with a lag, and it will be quite wise to watch and see at some point.
Well, that lag is certainly complicating the Fed's task at the moment. When is it realistic to determine whether the Fed has tightened too much? When will they actually know whether they're over-tightening?
Well, they're waiting for some cracks on the job market. So far, the U.S. economy is very resilient. And look at the job market, for instance. And my point is that if financing conditions were very tight, you would already see some cracks in the job market. So I believe that they will start to stop hiking rates and wait and see when they will be sure that on the one hand, core inflation has peaked, and that the next step is a mild, deceleration in inflation. And on the other hand, when they will see at the same time some deterioration in the job market. The Fed is not worried by a recession. We don't expect a recession next year. We expect subpar growth, lower than 1% growth. That's very low by historical standards. That's not a recession. And should the U.S. economy experience a recession, I think it would not be a game changer for the Fed. I mean, the Fed will monitor the possibility of a financial crisis or a deep economic downturn. We don't believe that a deep economic downturn is in the pipeline. The priority for the Fed is to anchor inflation expectations. So first, the Fed needs to see a peak in the core inflation. And that's the name of the game, core inflation still. They want to anchor inflation expectations. Real interest rates remain excessively low and in negative territory.
You sound more optimistic than most guests that come on the program around the U.S. prospects from the growth perspective next year. What about the UK? We are seeing some resilience in the pound this morning. Obviously, major developments over the weekend. Rishi Sunak now closing in on number 10. What is certain is that Truss is out and the bulk of her tax relief policies are also out. So what does this mean for the British currency in your view?
So first of all, for the UK, I think it's time to watch the situation. What we understand is that there is a U-turn in terms of fiscal policy back to some realistic program with Rishi Sunak that at the end of the day, if he's the one, because it has to be confirmed today, but should it be, Mr. Sunak, at the end of the day, he was right during the summer when he was campaigning against Liz Truss. So it will be much more realistic from a fiscal standpoint. It does not mean that you will go back to the initial point very rapidly. I mean, there is a loss of credibility both for British policymakers, both for the Bank of England and for the government. So they need to come back with a realistic program. And against this backdrop, it should be positive, I would say, at some point for the sterling and for bond yields that had peaked, during the fiscal crisis. That being said, we need to be cautious. We need to see, really what program they have in mind, and the global picture for the British economy is quite bleak, I would say, for 2023. They will be close to a recession. And when you said that I was more optimistic on the U.S. economy, that's true that for the United States, risks remains skewed to the downside from a macroeconomic standpoint. We don't expect a recession, but risk remains still skewed to the downside almost everywhere at a global level. In the United States, in the UK for sure, despite the return to a more realistic program, and in the Eurozone where recession is here already. So that's a big picture for the global economy.